The joy in stock market investing is that stock market volatility, though it looks abstract, but it can be measured. It's a measurable factor, you know, when it comes to investing. So measuring stock market volatility involves using various indicators like the Volatility Index. All right. That's the CBOE. CBOE means the Chicago Boards of Exchange Volatility Index. The VIX, or the Fear Index, is one of the most widely recognized volatility index. This tool provides insight into market uncertainty and potential price swings, helping investors and traders to make informed decisions as it relates to crafting their portfolio or mitigating the impact of volatility on their assets or stock portfolio. So in this case, we want to consider key indicators to measure volatility. What do you really take into consideration? What are the indicators you consider when it comes to measuring volatility? Number one is the Chicago Board of Exchange Volatility Index, known as the VIX. So what it measures, what actually does the VIX measure? The VIX gauges expected market volatility over the next 30 days, derived from the price of S&P 500 options. That is how you measure this particular, that's how you use this tool. It measures expected volatility over the next, 1 month or 30 days, so that investors can react accordingly. They can take proactive measures. So what is the interpretation actually? So a high VIX, a high VIX value indicates greater market fear or uncertainty, while a lower value, indicates it suggests stability, and it equally signals investor confidence. So how is it utilized? So traders often use the VIX, as a contrarian indicator to hedge against market downturns. If you expect, if the VIX index, indicates a kind of height, a heightened level of volatility, you could use that to equally hedge against, you could utilize it to your advantage, actually. So you could take, a contrarian approach. If you feel the market is going high, you act accordingly. If you feel the market will, undertake a downturn, you also, hedge against that accordingly. Number two is a standard deviation. Another very important tool, in measuring market volatility is standard deviation. And so what does it measure? What, does it measure? This statistical tool calculates the average dispersion of stocks prices from its mean over, a specific period. It measures that dispersion from the mean. If this is the mean, it measures a discrepancy from the mean value over, a given period of time. And what's the interpretation therein? So higher standard deviation signifies higher volatility and risk. If there is that higher deviation from the mean, it indicates, higher volatility, and that will then signal, higher level of risk. And so how is it utilized? It is used in portfolio analysis to assess the risk-return trade-off. That is, it gives you an idea of the level of risk you are taking compared to the return you are expecting. Are you taking too much risk compared to the return you are expecting? Or are you taking a lower level of risk compared to the higher level of return you are expecting. Number three, average true range. Average true range. What does it measure? You know, so average true range evaluates the range of price movement for a stock or index over a given period, indicating gaps and intraday price fluctuations. It measures the range of fluctuations, the range of swings, over the level of, swings, fluctuations over a given period. This will indicate, the level of fluctuations that will help intraday traders or day traders to be able to have a better decisions as it relates to their trades. So it's commonly employed in technical analysis to set a stop loss level. When you examine the range of fluctuation over a certain period, you could then look at the peak and look at the trough and know precisely how and where to set your stop loss so as not to incur, unacceptable level of losses, if at all there's an acceptable level of losses in the market at all. So please like this video and subscribe to this channel. Number four is historical volatility. Historical volatility. And so what does it measure? Historical volatility is based on past price movements. You could get that from a typical graph that is extrapolated backwards. You could get it from a chart. All right. So it's actually calculate standard deviation from deviation of returns over a specific time frame. It calculates standard deviation of the returns, of the expected returns over a given time frame. This is your returns. So you calculate the standard deviation above or below the returns, expected returns over a given time frame. And not only that, it's how is it interpreted? Actually, it reflects how volatile an asset has been historically. You just look at the graph and see how volatile it has been over the past months or even years. That will show you how volatile the asset had been and how it could be in the future. The other one, number five is Bollinger Bands. Bollinger Bands, these are very important instruments for day traders. So what does it measure? These bands are plotted, they tend to plot, two standard deviations away from, a simple moving average. The bands are plotted two standard deviations away from, a simple moving average. And what's the interpretation here? A widening band signals increased volatility, while a narrowing band suggests a kind of stability. This is the mean. So you take two standard deviations above the returns. This is the mean returns. So you take two standard deviations above the mean, the expected returns, and that will give you, a measure, give you an idea of, how stable or how volatile, the asset is. It is used for, spotting breakouts and reversal pattern, in the charts. These are instruments utilized, mostly by day traders and swing traders. And so why do we measure volatility? Why measure volatility? Measuring volatility will help investors, evaluate the risk of an asset or a portfolio. It equally helps to identify potential market turning points. It helps you to identify reversal, either reversal up or reversal down. So it helps to choose appropriate trading or investment strategies. It helps you to be able to, you know, adopt your strategies to adapt your strategies to the current volatility, in the markets. So understanding these indicators, particularly the VIX, provides a comprehensive view of market dynamics and equip investors to better navigate various levels of market turbulence. So it's very important you take note of these key indicators.